Welcome to the Hughes Optioneering Weekly Workshop, where we scientifically engineer trades for greater profit potential. This is the disclaimer slide. You can pause to read it. We're going to move on. Today we're going to look at NVDA, or NVIDIA Corporation. NVDA is the worldwide leader in visual computing technologies and the inventor of the Graphic Processing Unit, or GPU. Here's the barchart.com technical opinion rating for NVDA. The bar chart rating is a 100% buy with a strongest short-term outlook on maintaining the current direction. Long-term indicators fully support a continuation of the trend. The market is approaching overbought territory. Be watchful of a trend reversal. According to Prime Trade Select rules, a stock is in a bull trend on a monthly basis if the stock price is above the 10-period or 10-month simple moving average. The monthly chart shows that NVDA is well above the moving average line, so the monthly trend in NVDA is up. Now we're going to look at the daily chart. A stock is in a bull trend on a daily basis if the 50-period or 50-day exponential moving average is above the 100-day exponential moving average. The blue line is the 50-day EMA line, and the green line is the 100-day EMA line. The blue line has been above the green line since December, so the daily trend in NVDA is up. Next, we're going to look at a daily chart that displays the Keltner channel. As a rule, we don't want to buy calls if the stock price is above the upper Keltner channel line. Anywhere inside the Keltner channel or even below the Keltner channel is fine. NVDA is just below the upper Keltner channel line, so NVDA is inside the buy zone. Since the trend is up, we want to buy a call. NVDA has more option chains than I've ever seen, I think. Anyhow, they go all the way out to January 27. Okay, we're going to use the November 22nd option chain. Right now, the November 22nd options have 33 days to expiration. Here's most or part of the NVDA option chain for November 22nd. NVDA closed at 138 even on Friday. That means any calls on the list from 126 to 138 are in the money. Let's take a look at the profit potential for purchasing the 138 strike call, which is the closest strike to the current price of the stock. The bid-ask spread for the 138 call is 10.20 to 10.35. We tried to enter at the midpoint, so we'll use 10.30 as the buy price. Our call option calculator shows the profit potential for this call based on NVDA price changes at option expiration from flat to a 12.5% increase in price. We can see that if the NVDA stock price is flat at 138 even at option expiration, the 138 call will lose 100% of its value. Ouch! This is an unacceptable risk. That kind of loss can wipe out our trading account in a hurry. We developed what we call the 1% rule to help us avoid this kind of risk. The 1% rule says to limit the time value portion of the option we buy to 1% of the stock price. That means the stock only has to move up 1% for the call option we purchase to break even and start profiting. Now let's take a look at buying the 120 strike call to see if it qualifies for the 1% rule. Here's the call option calculator picture for the 120 call. According to the 1% rule, we want the call to at least break even if the stock price is up 1%. The calculator picture shows that if the NVDA stock price is up 1%, the 120 call will lose 8.6% of its value. We want that to be break even or better, so the 120 call does not meet our requirements. Let's see if the 100 call will work. The bid-ask spread for the 100 call is 38.20 to 39.35. We tried to enter at the midpoint, so we'll use 38.80 as the buy price. The 100 call works. If the NVDA stock price is up 1%, the 100 call will make a 1.5% or $58 profit. That's better than break even, so the 100 call is the one we'll buy. The call option purchase calculator also shows that if the NVDA stock price increases by 2.5%, the 100 call will make a 6.8% or $265 profit. If the NVDA stock price increases by 5%, the 100 call will make a 15.7% or $610 profit. If the NVDA stock price increases by 7.5%, the 100 call will make a 24.6% or $955 profit. The 10% and 12.5% numbers are also displayed. You can see that the profits get better and better. And notice that if NVDA does not make the expected move up and remains flat at expiration, the 100 call would only lose minus 2.1% or minus $80 compared to the minus 100% or minus $1,030 loss for the 138 strike call that we looked at earlier. Now we want to review a call option debit spread, aka a vertical call spread. For this spread, we want to buy to open the NVDA November 22nd 115 strike call and sell to open the NVDA November 22nd 125 strike call. We're going to base our entry prices on the midpoint between the bid and ask prices. That means we'll buy the 115 call for $25.70 and sell the 125 call for 18 even. $25.70 minus 18 even equals $7.70. So the entry price or debit cost for the spread is $770. The call option spread analysis calculator picture shows that the spread will make a 29.9% or $230 profit if the NVDA stock price declines by 7.5%, remains flat, or increases in price when the options expire. Creating the debit spread will allow us to collect an $1,800 cash credit to our brokerage account for the sale of the 125 call. As we said on the previous slide, this reduces the cost of entering the spread to $1,800. Here's a note regarding earnings reports. The next NVDA earnings report is scheduled for November 19th. Let's review the trades one more time. The first trade was a call purchase. It said to buy to open the NVDA November 22nd expiration 100 call for $38.80. We also reviewed a spread. The spread said to buy to open the NVDA November 22nd 115 strike call and sell to open the November 22nd 125 strike call at a debit of $7.70. That's it for this week's Optioneering Workshop. Thank you for joining us. We look forward to seeing you again next week.